Welcome to Market Monday from the investment team and the trust department at the First National Bank. We have a couple of interesting reports over the next few weeks. The schedule of economic data releases is a little bit slower than it's been over recent months. We do have some consequential information coming. Also going to recap recent commentary from the Federal Reserve and its implications for markets. Talk about the equity markets and the recent spot of volatility that we've had, and we'll finish up with rates and kind of what the outlook is in the nearer term. Starting things out, earlier today we got the Purchasing Managers Index. That's a sentiment indicator. This stuff came in pretty mixed, so services looked a little better than expected, manufacturing looked a little worse than expected, and that's not really a conclusive message one way or the other. Later on, coming tomorrow, we get information on the real estate market. We get consumer confidence. Now, that is a really important number, seeing as how consumer spending is about 2/3 of GDP. And we'll note that the expectation here, consensus estimates on the survey, show 93.9 as the expected read, where it was last at 98.3. So that shows a little bit of a drop in consumer confidence is the baseline expectation. We'll get information, again, sentiment indicators on business conditions, more information about real estate market, mortgage applications. That's a volatile number, though, not really as consequential. Durable goods is. This is expected to show a pretty good swing to the downside, 1% decline month over month versus a 3.2% gain in the prior. That would be interesting. That suggests that consumers are starting to be a little bit more cautious in their big ticket purchases. So we'll watch that. We get the GDP from the fourth quarter final reading. That's expected to not show any change at 2.3. And wholesale inventories, inventory conditions are interesting. They give us kind of a clue as to what's happening in the supply chain. Is inventory building up and not being sold, and is that because orders are slowing down from consumers and therefore the economy might be slowing? All of that stuff kind of is part of the mosaic that we use to glean the information as to what's going on in the overall economy and underlying the markets. We'll get information about the price index. Now, look, that's an inflation index, GDP price index. These inflation indexes, CPI, PPI, have been coming in problematically strong over the past few reports. Even though we're seeing a weakening condition in the labor markets, even though we're seeing slowdowns in demand and potentially slowdowns in GDP growth, we are also seeing persistent high inflation. So that has something of an influence. Income and spending will be germane to the inflation condition. Income expected to show only a 0.4% increase month over month, whereas the prior reading was a 0.9 increase. And personal spending is expected to swing positive. Now, again, these are kind of inconclusive and at odds. Probably it isn't a good thing if spending's going up while incomes are going down, though, just as a point of common sense. We get the PCE indicator, that's the Fed's preferred index for inflation, and that's supposed to come in at the core PCE, which is what they're using to guide policy, 2.7%. That's a rise of 0.1% from the prior reading. Again, that argues that inflation's kind of truculent right now. We're not sure what policy tools are going to remain available to the Fed if and when they need to ease monetary conditions even more, because where we stand now, and they even nodded to this in their most recent statement, is we have higher than what we want to see for inflation, and we're starting to see weakening in the economy. Normally, the policy response would be to make monetary policy easier, lower the overnight lending rate, and potentially do some asset purchases to keep rates lower and and therefore, if the cost of money is going down, that juices the system and allows things to flow a little bit more freely and potentially eases economic conditions and helps in a recession. They won't be in a position to do that right now, and so it's going to be a really interesting time to see what they do. University of Michigan sentiment, again, that's another sentiment indicator coming in flat is the expectation. And, rounding it out, more labor market information, more durable goods information. The trade balance, this is interesting because particularly in light of all of the tariffs that are going on and the different trade negotiations, we're expecting to see this trade balance get a little bit better, but that remains to be seen, and that's not something that happens overnight. And we'll round out again with more information on the labor market. So, some interesting information, and we will get a little bit better of an idea as to what's going on in the marketplace. The S&P 500 has been really in the news. Equity markets have been extremely volatile throughout, late February, most of March. And it's been unsettling for some investors, but this was really starting to telegraph in the middle of February when we saw ranges trend up. That's this bottom line here. We start to see this go up. That means that the average difference between the highs and lows of a day is getting bigger and bigger, or there are just bigger swings up and down during the day. And the VIX index, the volatility index, bears that out as well. That had a recent spike right around the 10th or 11th of the month, and now it's coming back down. And notice we almost got up to 30. We got to 28 in this VIX. That's pretty high. That suggests that fears were at a very elevated level, and that they've since receded down below the key 20 area, where we would consider this more placid, normal market conditions. But we don't think the current spate of volatility is necessarily over. We haven't seen any kind of conclusive evidence that points to that, and in light of the recent weakening in economic reports, it's simply too early to say that, hey, we're out of the woods yet. What we are advising is obviously what we have always talked about on this program. We don't want to make changes to good long-term plans based on short-term events. And if anything, when we look out further and zoom out further on the lens, over time, as a long-term investor, these little drawdowns that periodically happen are baked into our investment plan, or big drawdowns in some of these cases. They're baked into our long-term investment plan, and still the overall long-term trend, we want to be owning stocks, we want to be sticking to our plan. So in terms of treasury yields, over the past month, rates have come down a little bit. And this is interesting because when we have inflationary conditions, we really expect that interest rates are going to go up in the Treasury curve, because in the Treasury curve, the only pricing mechanism for yields is really based around inflation risk. So when you look at Treasury yields, that's a proxy for what large investors think inflation is going to be over any different point in the curve. And if rates are coming down, that means bonds are being bought. And the only reason that the large investors are buying the bonds at the same time, incidentally, that they are selling stocks, which is going on here in the same time frame that rates are coming down, the bond prices move inversely to yields. So this means that bonds are being bought pretty aggressively while stocks are being sold. And that suggests that the bigger investors have, in fact, been taking off their equity risk and putting money into a safer asset class, which is the U.S. Treasury, widely considered to be the quote-unquote risk-free asset. In other words, the U.S. government is thought to not be in a position to ever default on its debt. And moving into the corporate yield curve, this looks a little healthier. Still, it's come down a little bit as well. But we're getting yields of, say, 4.6 all the way out to maybe 5.4 over the next, 5 to 15 years. So what that's doing is it's paying investors to have positions in their portfolio that hedge some of the equity risk away. Bonds tend to zag when equities are zigging, and we want that, and so you're getting paid a good coupon for that. But on the other hand, too, for fixed income investors that are living on the interest payments or taking the interest payments to pay for other things, that's also pretty good. What does this all have in terms of implications for monetary policy? Well, the Federal Reserve's last meeting was rather interesting. They did a lot of talking about not much of consequence. They mentioned that they quote-unquote think the risks are balanced. So what does that mean? That means that the risk of inflationary conditions and the risk of a weakening economy are about equal in their view. And then they chose to keep the rate the same. They did change slightly with their dot plot, which is what this is here. And, the rates are a little bit more skewed toward the upside as we go out, from the last meeting versus this meeting. And we look at the differential there. The average or the median forecast is moving slightly up, even though, language was given to the effect that they're neutral, they don't want to do anything, raising rates or lowering rates at this time, and that they're going to be data dependent. These results suggest that there is a slight bias toward hiking rates inside the Fed, or at a minimum, willingness to allow rates to remain higher, which is more probable than a rate hike cycle would be for them to just let rates remain a little bit higher over the nearer term. But again, we're zoomed out. We're not looking at this short term as anything other than an opportunity at this point. If there is a recession, we're not expecting it to be an extremely deep or consequential one. And, the odds are not terribly bad for there being a recession right now. About a year ago, the New York Federal Reserve released its probability estimate for 1 year hence, and that was about 60% chance. And we're right around in that area now. So, the Federal Reserve's advanced indicator even suggested that we might see a recession, which is only just 2 consecutive quarters of declining GDP growth. And apparently now, it hasn't always been the case, but apparently now, some amount of subjective judgment on the part of the National Bureau of Economic Research. But with that said, if we do see it, we're not expecting to see something that's tremendously deep or long-lasting. And with that, we'll close out again. We're taking the long view. If you have questions about the portfolios, if you have questions about economy and markets, what does this all mean for my investment plan, those type of things, feel free to reach out. We'd love to talk. Hope you found this video useful. Thank you. Have a great day.